morning, everybody, and welcome to the Fred Report Technical Market Conference Call for May 12, 2011. We'll get right into it here. I guess the first thing to say is so far the stock market is acting about as expected. We've been up in the first part of the week, down so far in the second part of the week, but we continue to expect some choppiness and weakness into the end of the month. We're certainly not surprised by this action, except that, again, we would say that overall the market may be actually trading a little bit stronger than we would expect. We're still not big shorts in this market. We're really not playing the short side here that much. What we're really looking for is a nice pullback to add positions, and I'm looking at the SPY even as we speak. There's a nice gap around the 131, 132 area, and I do think we can close out the month around 128 or so. If we were to do that, it would be the perfect setup for a second half of the year rally. But regardless, we're still thinking the second half of the year is probably going to be strong. When we look at the bond market, it's also rallying. The TLT and such are really quite overbought, but given that, they look like they could trend up a little bit more here. I think this is a counter-trend trade, and what we've been talking about for people is, and again, this is more for new subscribers, over the past couple of months, we've been adding bonds with the idea being we'll get a trade in bonds to the upside, and then rates are going to slowly creep back up as economic strength and such takes hold in the second half of the year. And that scenario is on track. We also point out to everybody we've been looking at the municipals, the MUB, the CMF, some of the ETFs that deal with these municipal bond funds. These have been rallying rather sharply since we got interested in them in March. And I have to tell you, the news that these things are all going to default and such may be specious. I would be talking to my muni desk and such and looking to add good municipal bonds to portfolios that are looking for municipal bonds. Certainly now is maybe a little late. It was better back in March and April, but even so, the technical pattern on these municipal bond indexes and ETFs are such that these look more to be up and not down markets. In other words, the risk of a big mess in that market seems to me to be relatively less than people would think. Now, obviously, the big news of late has been the commodity markets. And let's talk a little bit about the commodity markets, first of all, from a technical perspective. The first thing to realize on commodities is they have a tendency to make a seasonal low in May. And they seem to be trying to do that without being funny. Let's talk for just a minute about cycles. I've used this example with a couple of people by email and on the phone with some of our consulting clients, and so let's just go into this. In a perfect world, in a perfect cycle, you would go up exactly as much time as you go down. So picture in your mind an equilateral triangle where both sides of the triangle are the same length. In other words, you go up, you go down. In a bull market, you skew over to the right. You spend a lot more time going up. You do spend time going down, but it's very sharp. And in a bear market, you spend a very short amount of time going up and then a longer amount of time going down. And what this looks to me to be like here is a period of extreme right skew or right translation in these commodities. What that means is we spend a lot of time going up or coming down sharply. These things could actually rally fairly substantially into the end of the year after we make the seasonal low in May. Should that occur, and the dollar rally as well, we want to be involved in these markets. I had a nice discussion with some people on Indian TV yesterday. Very few people, especially outside the country, believe that the dollar and commodities can rally together. I think they can. The reason for that is commodities have their own fundamentals over and apart the currency differences. In a recession, the currency relationships are by far the most important. Commodities will trade inversely to the dollar, but when you get into a situation where there's supply and demand for the real commodity due to economic strength, you can certainly, the commodity will rally regardless of what the dollar is doing. We've seen periods like that in the past. So that could be a big surprise to everybody in the second part of the year. When I look at the metals in particular, GLD is trading rather nicely. It still hasn't hit my target to overweight around 138 to 140 in spite of all this hoorah. We're actually higher than the lows at 142.50, where we went in and went back to an equal weight on these things. Now, if you look at silver, the story is different. Silver is making new lows, and that's actually a positive for the metals. The point being, when gold outperforms silver, the metals markets are healthy, and when silver is outperforming gold, it's exactly the opposite. And we saw that recently. Silver took off for the whole month of April. Gold sort of sat there, and look what happened. We had this terrible decline. So the fact that gold is actually acting healthy bodes well for these metals in the second part of the year. It's probably not time if you're a trader to go in and buy these things, but they're certainly acting a little bit better. Let's talk for a little bit about crude oil. I'm looking at the USO right now. We've been forecasting a possible move into that gap at 37. It's come quite close. I think it can ultimately fill that gap. Oil normally bottoms in May and then rallies June, July, and August for what they call the summer driving rally. I see no reason why that's not going to occur here. Obviously, the moves down have been a lot more volatile and such than people expect, but I think that that's doing a good job of creating fear in these markets. When we get our next buy signal in oil, we will take that signal and we will let everybody know, because that could be a really, really positive development for us and a very good trade to the upside. With that, we're going to move into some individual stocks.